Professor Siegel joins us now from Philadelphia. Professor Siegel, what do you make of this morning? We're saying this is unbelievable.
Well, you know, I did a year ago predict 18,000, and wow, luck should have it. Here we are just about Christmas, and at that level, I still think, as you said, this bull still has room to run, but we are much closer to fair market value, certainly than we've been any time in the last 5 years. So that means the range of outcomes is also more uncertain. But I like the tailwind that we have from the oil price decline that, of course, we've seen in the last 3 or 4 months. I think that's going to make for a good 2015 economy, keep interest rates low. I'm not even sure the Fed is going to tighten until way in the autumn, and that's still a very good climate for the stock market.
So, Professor Siegel, you just, I think, may have hedged a little bit there. You said we may be heading towards fully valued. You had predicted that we'd be at 20,000 by, I think, the end of next week. What do you think about the prospects of 20,000? Well, you said at the end of 2000, you know, you said at the end of 2014 at one point, or 2015, okay? So,
15.
Where are we on that?
I think we can definitely get there. I mean, from 18,000 to 20,000 is about 11%, which is a good run. It's about what we've had this year. So certainly 20,000 seems like a huge number, but it isn't that great. And I certainly think we could get there. But I also say we've had a long time without a correction in the market. We almost got there with that Ebola scare. You know, 2015, there's still a lot of uncertainty. I think we could maybe have a good first half, a little bit of a sinking spell, maybe a correction at 10%, and then maybe go out the year strong. But one has to realize short-run predictions in the stock market are very hazardous. I can only speak to fair market value, and given the interest rates that I believe will prevail over the next year, I still think the fair market value of the U.S. stock market is about 10% higher than what we have today.
What specifically could cause a correction? Do you see asset bubbles anywhere? I mean, tech valuations seem pretty crazy.
Well, actually, overall, tech valuations aren't crazy. I believe that the tech sector of the S&P 500 is only selling for about 15 times earnings, a little bit even less than the index. What we see, of course, is some of those, Alibaba, Amazon, Twitter, Facebook, some of those newer stocks. They're not in the S&P 500. Those are the ones that, of course, are selling on expectations. But overall, it is so different than what we saw in the bubble of 1999 and 2000. And at that time, it's almost incredible to think about it, but the S&P 500 tech sector was selling at nearly 90 times earnings, 6 times more than it's selling today. So I don't see any rampant speculation. I really see solid values in the stock market and attractive values in the stock market, again, given the low interest rate world that we live in.
So Professor Siegel, what do you think is really driving this? Is it corporate earnings that are exceeding expectations? I mean, obviously, corporate coffers are filled. Is it low interest rates? Is this a Fed-driven rally? Which one is it, or is it a combination of both?
Well, it's a combination of, I think, the realization. I mean, the big change. I mean, I thought at the end of last year, someone, they asked me about the 10-year Treasury. I said, hey, it's going to 4.5, we're really going to start the hikes. Well, look at what's happened. I rethought my whole interest rate scenario, and I'm convinced that, yes, interest rates will go up in 2015, but not nearly as much as most people believe. I think, as even Bill Gross said, the new neutral Fed funds rate is going to be around 2%. The Treasury may be 3%, and that's going to be 1 or 2 years out. Well, think about it. In that environment, dividend-paying stocks yielding 3-4%. You can get a lot of blue chips that are in that category. They're going to start attracting money. People need income. The baby boomers are retiring. They're beginning to give up on bonds and interest rate instruments because they're just not high enough. I think that movement from bonds to stocks is going to continue in 2015.
But could you attribute another reason we're getting this leg up is because Europe is worse than we had anticipated?
Well, it is true that there's money flowing to the dollar, and that's one reason the dollar is high. And when we see that, and I actually think against the euro, we're going to see it even higher. But don't forget, except for the euro, European stocks are selling at 15 to 20% discounts off of U.S. stocks. There is value there. It's only a question of how far down does Draghi want to push the euro in order to spark a recovery that we have here. There's a little bit of a risk of to dollar-based investors because of that, but there are sound values in Europe. There are unbelievably sound values in the emerging markets today. Boy, they've been hit. We know Russia, China has come back, but Russia and many of the other currencies. Actually, when people ask me, Jeremy, next 3 to 5 years, what sector you think is going to do the best? I don't pick the U.S. stock market. I actually think the emerging markets as a group are going to be the best performers
Specifically where?
Going forward. So. Well, I think I'm not going to pick individual stocks. I'm certainly a contrarian. If you don't think Russia's going out of business, you're getting them at 3 and 4 PE ratios. But even China, you're getting at 10 and 11. I mean, China's growth is not going to go below 3-4%. It's going to be a 6-7% grower. That's an incredible value going forward. And by the way, I'd spread it around. I'm not going to try to pick particular winners in the emerging markets. There's a lot of wonderful emerging market ETFs that you can invest in that really spread the risk around. I think as an asset class, it is very attractive. Even though U.S. is going to do well in Europe, I think emerging markets, 3 to 5 years, will get the best returns.
Quickly, Professor Siegel, any concern about that risk is being mispriced now in the bond market?
Well, you mean the bonds are too high in the risk? But take a look at what's going on with oil. Oil, there's going to be headline inflation, perhaps negative, in the first 6 months of the year. I mean, this is really going to pull prices down. And, are we going to see the Fed tightening in a zero inflation environment? Don't forget the two big hawks on the FOMC, Charlie Placer and Richard Fisher. They're leaving the Fed in 2 or 3 months. So really, when you talk about the voices that are going to be there, they're not hawkish voices. They're not going to be increasing the rates anytime soon. That's still a wonderful environment, I think, for the stock market.
All right, Professor Siegel, always great to get your thoughts, especially on a day like this. Jeremy Siegel of University of Pennsylvania, Wharton School of Business.